Welcome to the preview of the Creditor Watch Business Risk Index. Australian businesses have turned in a remarkable performance during the pandemic, demonstrating an incredible level of ingenuity during difficult circumstances. But the more information they have at their fingertips, the better their decision making as we come out of the COVID period. From Wednesday next week, they'll have an important business tool to guide their decision making. Creditor Watch is proud to announce the first ever Business Risk Index in the Australian market. This tool is set to become one of the most important inputs businesses have to guide their future planning. So this morning, I'm joined by Creditor Watch CEO Patrick Coughlin and James O'Donnell from Open Analytics, who designed the index. Before I throw to Patrick, I'd like to welcome everyone today and let you know that we'd love to hear your questions, which we'll get to at the end of the session. Over to you, Patrick.
Excellent. Thanks for hosting today, Ali, as always, and James, good to see you again. And thank you to everyone listening in from home or office, wherever you might find yourself. It's a really exciting day. It's not the most exciting. Obviously, next week when we officially go live, we'll be the we'll top it all. This has been something that's been in the making for quite some time at Creditor Watch. There's a meeting of the minds between myself and Mitchie Coper, who is our GM of Communications and Marketing, and of course James O'Donnell from Open Analytics. The Business Risk Index, as Ali said, is going to be a real game changer for industry, for government, for researchers, analysts, universities, etc. It's an incredibly powerful, predictive tool that will find additional use cases for, I would imagine, ongoing and into the future. I can't wait to get this live. I really want to be able to share not only the data that Creditor Watch has, but be able to show it in a way that allows people to sort of delve deeper into it. And I think those that who do look at it closely, as with everything we do at Creditor Watch, it's really important that we get the feedback, and that helps drive future innovation as well. We're experts in part of what we do, but we love hearing from those in other industries, countries, or various states or regions themselves who would like to make adjustments or query or challenge how we're doing things. So it's certainly going to be an extremely fluid process and project. And really looking forward to getting stuck into it today. It is going to be that key economic indicator that I think will be held in high regard in the media in particular, and reported on a regular basis. So I might pass to James to touch on it a little bit, and then we can start having a look at some of the sort of key measures and insights that he's got.
Thanks, Pat. So I'll just give an intro on myself. So James O'Donnell, the Managing Director of a company called Open Analytics, and what we do is specialise in all things credit management and credit risk. So the way I like to explain to people what our business does, we help primarily banks and lenders design credit decisioning and credit rating systems. So what we're doing here is very much in that ilk. So look, as Pat mentioned, the Business Risk Index, it's a new economic indicator. And what it is, it's really a measure of future or forward-looking insolvency risk. But the way I like to explain it in simple terms, it really is what I describe as a regional credit rating, and it's analogous to the work we do in credit rating individual businesses, but rolled up to regions across Australia. So Pat, if you pop the next slide on the presentation, just to give a nice sort of pretty picture and a visual. So as I mentioned, the best way to conceptualize it is a regional credit rating. Now we're publishing it for around 300 regions across Australia. So in technical speak, we've developed it at a SA3 or statistical aggregate 3. So that's just a standard aggregation set in stone by the ABS. And you can sort of see on that heat map there, sort of the granularity there. So for some context, there's about sort of 50 odd of those regions in a big city like Sydney. and then sort of about 300 odd across the country. The
And
data
I
that
think,
feeds
sorry,
into
I'll
it.
just jump in really quickly just to reiterate what Ali said. You know, we're keen to answer questions along the way, and I know Ali's got plenty of questions ready to fire at us too.
Yeah. Just to finish the opening spiel, the data, there's a lot of data that goes into it, but the population that this model is built on, it's about 1.1 million businesses. So we filter down to ASIC registered regular companies, and we filter down to credit active businesses. And that simply means businesses that have had any bureau or other credit activity in the last 10 years or so. So that's basically what the index is. And if you'll indulge me one more slide, Fat, if you click onto the next one, just to explain, you know, we use terms like credit rating as if everyone knows what that means, but a credit rating really is a measure of default risk or insolvency risk. So what the index looks like, or the data behind it, you can sort of see in that table there on the slide. So what the model effectively does is take all the businesses in each region, we aggregate them together, and we publish a regional probability of default, or PD as it's often termed. So that's basically a view of, for that region, what percentage of businesses do we expect to go insolvent over the forward-looking horizon of 12 months? And then the index itself, it's what's known as a rank index. So what we do is we simply rank regions from best to worst, best being the lowest default risk, and then we put them on a percentile or a decile scale. So the final index will be a number between 0 and 100, and basically if you get 0, you're the highest risk region in the country, and if you get 100, you're the lowest risk region in the country.
Beautiful.
Thanks, James. That's an excellent introduction. I'd now like to throw some questions to Patrick. So James gave us an excellent definition of what the index is. From your perspective, what is the index and what is its purpose?
Look, I think that the key to it is to really show where risk exists within the country obviously at a regional level, using that technical SA3, you know, but it's, as you can see from the map that we showed earlier, and I'll just jump back to that so you can have a look. You know, it's really giving anyone who's, you know, wants to have a look at whether it's credit risk, whether it's using it from a sales and marketing perspective to know which regions and businesses within certain regions that we want to target for new markets. You know, think of what it would be to be a lender. You know, you could be a lender who wants to specialize in, you know, providing secured finance to you know, really healthy regions, and you could be a, you know, an unsecured lender who specializes in providing risk to businesses that are not doing so well. So they'll actually look and probably target those obviously higher risk regions. As part of this, we are looking at probability of default for industries as well. So when you compare that together, combine that together, it becomes a really powerful tool for targeting, you know, business or industries at a regional level too. As I said before, I think for government in particular, it's a great way for them to be able to understand where they should be focusing attention from, you know, an investment perspective, forward looking, but also it's a great way to have a look at, you know, what have they introduced in some of the better in some of the better regions or some of the worst regions, to see how successful that investment in prior years has been. So there really is, you know, a huge number of use cases out there. And I think, you know, if we come back to where we find ourselves at the moment in the current economy, you know, SMEs in particular, look, they make up 90+% of all businesses out there. They're the ones who are doing it the toughest, arguably. This is a great way for us to support them, for businesses to support them, for government to support them by giving better insights. Any way for business to be better looked after, or for themselves to fend for themselves in a better way by potentially avoiding, you know, higher risk industries, is a really, really powerful tool. And getting that mid-market, that SME economy going again, booming again, will mean that Australia really comes out of, you know, this doom and gloom that we've you know, had to endure for close to 2 years, or coming up to 2 years by the time we're all free to travel around again is only a positive, and this is going to make a big difference in supporting that.
That's a great segue into my next question about why now. You know, trading out there is so tough. Some industries are closed altogether. If you're in one of those industries, how are you going to be able to use this?
Yeah, look, it's a great question, and I think, you know, from a timing perspective, you could introduce something like this at any time, to be honest, and it would be extremely beneficial. I think the fact that, you know, we're in the middle of a pandemic and significant downturn, but about to accelerate out of it, I think it's going to give us really good insights into which regions and industries need additional assistance. Could be something that, you know, has targeted stimulus off the back of it. From a timing perspective going forward, what we'll also be able to see is, you know, where as a business owner, we could be making investment to take advantage of, you know, quicker rebounds in certain industries or locations as well. And I think what we'll see over, you know, the coming 12 months in particular as well, once we start to see normal collection rhythms return, normal payment rhythms return, particularly with the banks and the you know, larger creditors out there, and of course the ATO, when they get back into their normal collection rhythm, how that is going to affect, you know, particular regions or industries as well.
Yeah, I think for me, you know, it'll be very interesting to see how public policy makers feed this data into their decision making, because they've never had access to this sort of information before.
Yeah, it's a total game changer, and some of the numbers that we're seeing, and James will touch on them soon, is just providing incredible insights. You know, if you're in, you know, policy making and you're not sort of at least having a look at it and gauging how it can help, I think, you know, they're doing themselves a disservice. Obviously, you know, the likes of Treasury and ATO and you know, a lot of the government departments have incredible data that is coming through, but this really is using a huge amount of unique data that is simply not available anywhere else. You know, we've got, you know, 90% of our customers that use Creditor Watch use us exclusively. So the data that they're providing and the insights that we generate from that data, whether it's producing a, you know, an individual credit risk score on a company, or you know, into the business risk index and having a look at a region or a state or the national level, it's incredibly powerful information that should be used in future decision making.
There's a colossal level of, I guess, grunt behind it. So Patrick, I've been privileged to see some of the initial findings from the index. Can you take us through any early results?
Yeah, look, James has got a couple of case studies, so I won't steal his thunder there. But I think, you know, some of the data that's going into it is really interesting that James will show, just showing the sort of effect that the pandemic, particularly post JobKeeper, once that came off, you know, there was all this talk about, you know, huge insolvencies and zombie companies, and I was certainly, you know, on the record as saying that they were coming in the middle of last year. The support from a JobKeeper perspective, and also the insolvency legislation that was introduced to protect businesses through Safe Harbor, you know, carried everyone through that real, you know, COVID 1.0, which I would say sort of ended, you know, at the end of JobKeeper. And there was, you know, most businesses were flush with cash, and consumers were flush with cash, and we bounced out of that, you know, those lockdowns in late last year, early this calendar year. So what we've then seen is this huge downturn post JobKeeper from a revenue perspective, and James will look at that later on. So that's a real eye opener, and it's a real worry, particularly as it started to fall in those sort of, you know, normal months of, you know, March, April, May, June, before, you know, Victoria and New South Wales went into their extended lockdowns. There's also a couple of really interesting, you know, geographic areas that probably will raise some eyebrows. You know, some of the data looking into it, like, you know, housing affordability and commercial rents and whatnot, certainly get you to start thinking about, you know, how to treat businesses in certain geographic areas.
So the market's very used to Creditor Watch's business risk review. How does the new business risk index incorporate the business risk review? What a mouthful.
Yeah, So they're very much linked, and they'll be essentially reported on at the same time. The business risk index is, a turbocharged version of the business risk review, which was really looking at black and white stats. It was looking at insolvency numbers, court actions, defaults, that sort of thing, payment times. Very black and white. And then economists and we've obviously got our in-house economist in Harley Dale can make can create insights or think about what that means for the future. What the business risk index is doing is it's sitting over the top of that. It's hoovering up all of that information plus a huge amount of additional data from various data sources and actually showing a forward-looking prediction and going into a regional, region by region area and also an industry view. So it complements what we've been doing, but it just takes it to that next level. And a question I would often be asked by a lot of journalists is, what does this mean? What does it look like in 12 months from now? Well, now we have exactly the answer for them.
It's really interesting. I'm keen to find out how it sits alongside other indicators like GDP, which is very much backward looking, but this is so much forward looking. How do they all work together?
Yeah, look, I think it complements it. There's no magic source out there that we can all rely on. As you said, GDP is very backward looking. There's plenty of predictions that get reported on by the various economists from banks and industry around the nation. But that data also comes out months after it occurs. So a perfect example of that is GDP numbers for the end of June this year came out, and they were pretty positive, but ultimately we knew that they were redundant, really, because we were 2 months into severe lockdowns by that stage. So I think the benefit of this is in complementing it, and we kind of know what's going to happen to an extent from a GDP as we open back up and we see positive numbers return, is that this is giving a 12-month forward-looking prediction. And also having a look at really drilling into individual regions and industries as well.
On a practical level, if you're, say, a manufacturing business that sells your products all over Australia, how can you use this information?
Yeah, so I think there's two ways. So keeping in mind that the data that's being used in the business risk index is the same data that's used in our credit reports and our credit score and our payment rating. So while you might have the worst region in Australia, which I haven't named, but I think James touches on it, or it may have been on that next slide. That doesn't mean to say that every business within that particular region is a huge credit risk. You could have the best performing business in that worst region is far better to deal with from a credit risk perspective than the worst performing business in the best region. So, I think what's really important is it's used to be able to make fairly high level rules in terms of, credit risk. Companies within certain regions are going to be a higher risk on a generalization, on a general sense. However, you have the ability to then drill down into the individual business's credit report, see their credit score, and actually see how we're predicting, what prediction we're providing for that particular entity's, probability of default over the next 12 months. So I think it certainly assists existing credit risk processes and procedures. But then again, you've got the flip side of the coin, which is sales and marketing. I want to grow my business. What regions, what industries can I target that I know are likely to be in better shape and are probably growing and are probably cashed up and are probably taken advantage of lockdowns for whatever reason. If they were in a certain area that wasn't locked down, it's a great way to really start to plan how you're going to grow your business.
And what about from a government perspective? Because there's obviously 3 levels of government. So, local, state and federal governments could draw on this data. How can they make the most of it?
Yeah, look, I think the initial thing is to start having a look at the data itself, right? And then that's going to feed into either plans that are in place for investment or plans in place to support, whether it's economic growth, industry, or planning as well is really important. So I think the first step is to really understand what the data is saying Does it fit into, you know, existing plans? And then I think the second step is to start to go, okay, we can actually put in some, you know, different strategies based on the data that we're seeing in the Creditor Watch Business Risk Index.
That's great. Thank you so much, Patrick. I can't wait for the real launch next week. So I'm now going to throw to James. James, how did you put the index together?
Yeah, okay, so Ali, there's a very long answer to that, and then there's a short one. I'll give the short one. So I think the best way to answer that is to focus on the data that feeds into the index. So I've got a graphic in 2 slides along in the deck. So I guess the key concept is, I think Pat touched on, is that we're essentially using the machinery of Creditor Watch's rating system. So the way we've designed this model, it's what's known as a mixture model. So it's actually mixing 2 quite different data sources. So number 1 is really that dynamic individual business level data. And I'd sort of call out some of the key sort of factors within that data is B2B transactional data. So where Creditor Watch has a very large database of B2B transactional data that effectively picks up trade payments, so businesses that are paying on time versus late, and then also trade turnover is a very, very key indicator. So that sort of component of the model, it sort of makes up sort of 40 to 50%. And that's really sort of, we're really literally going down to individual businesses and credit scoring them. Then what we've done is we've mixed that in with more of what we sort of term as structural economic drivers. And we think this is quite useful. It really helps for intuition, which I think will be borne out when I show some case studies. But you can see that graphic, for those that you can see in that graphic there, the sort of economic indicators that are quite interesting and the most predictive. Number 1 is actually commercial rent prices and commercial property prices. So all other things being held equal, a business operating in a, you know, high commercial rent area of Sydney or Melbourne struggles a lot more than lower rental areas like Adelaide or some of the regional areas. Then broadly speaking, there's measures of income and wealth, so sort of socio-economic drivers, so things like median incomes and things like that. So basically we join all that data together into the regional rating system. So that's more or less how we build the model.
Can you take me through a case study of a region that scored well?
Yeah, I can. It's Pat, you might have to help me go a few slides along.
Yeah, no problem. I'll skip through a bunch. Oh,
actually, maybe pause on the state view, because okay, no, we'll start. Look, I'll start with one. Okay, on the state view, there's some interesting state trends that and perhaps sort of counterintuitively to some, like the lowest risk major state in Australia is actually South Australia. And then the highest risk is quite routinely Queensland. And then good old New South Wales and Victoria seem to sort of jostle it out sort of around that average. What we're seeing general trends that within sort of Queensland, those sort of tourism driven industries, so places like the Gold Coast, which I'll talk to shortly, that sort of dominate those sort of high risk regions. In Adelaide and South Australia and other parts of the country, you get this combination of areas with very low commercial property rents, but actually quite high on socio-economic measures. So around Adelaide suburbs, you get quite high wealth areas. So there's a lot of disposable income, yet the sort of the rental costs on your retail shop or restaurant is much, much lower than, for example, in any suburb in Sydney or Victoria. So I might start with a high risk case, if you don't mind, the Gold Coast. So if we pause on the next slide, so this sort of shows a bit of a scatter plot of every region, and it shows the vertical axis shows the most recently observed 12 months of default rate, and the horizontal axis is what we're predicting for a default rate in the forward 12 months. So basically, if you're a region that finds yourself in the top right-hand corner of that graph, that basically means that you had a high default rate last year, and we're expecting it to stay high. So I've sort of circled Gold Coast there, and if you move to the next slide, we'll show a tracking of the index itself on that region. And you can see sort of the country median sits at 5 there. I've sort of put this in the deciles, and you can see that the Gold Coast is sort of invariably sort of in that worst sort of 10%. But in recent times, it's actually deteriorated quite a bit. And there's really some of the drivers behind that are described on the next slide. Okay, so to start with the actual insolvency rate. So if we track the Gold Coast versus the rest of Australia, the dark line on that chart is the national average. So you can see we've sort of highlighted that period that's sort of impacted by COVID policy. So some of the things that Patrick mentioned around, you know, ATO being lenient on tax, banks giving payment holidays, and then of course JobKeeper and the more direct government support. Most regions' default rates actually went down over that period, but Gold Coast actually stayed flat and actually went up. So you can see that sort of gap between the insolvency rates actually widened quite a bit over this COVID period. So that's sort of the first thing, that the actual insolvency rates. Then if you go to the next slide, now I mentioned the creditor watch data that feeds into the index. So it's actually a multi-factor rating system with 30 odd factors, but I thought this was probably the best one to sort of highlight a key trend. What this shows is for the region, the proportion of businesses with B2B trade payment defaults. So these are businesses that have late arrears who are registering defaults with creditor watch. So you can see in that sort of COVID period, the rate of defaults within the Gold Coast has really shot up. Wow. Now we've seen, yeah, it's quite marked. So we've seen, in general in Australia, we're seeing those trade payment defaults go up ahead of other statistics, but it's sort of in the Gold Coast and other sort of tourist areas, we're seeing it get quite a bit worse. So that's probably an example of one of many factors in the rating system. So then as a result of that, the average credit rating or credit scores for businesses in that region is quite a bit lower than the rest of Australia. And then finally, a view on the next slide, the more structural drivers. These are the way I think about this. These are the economic indicators that are more sort of enduring. That's sort of why the insolvency rate sort of generally high in this area. And what you tend to see in the Gold Coast region, very high in comparative personal bankruptcy rates, sort of the second from the right there. So basically personal bankruptcies are much higher than the rest of the country. Median income's a bit below average, and then the property costs are at the higher end as well. So they're probably the key sort of structural drivers for the Gold Coast. Now, I realise I didn't ask you a question because you asked about a low risk one. A little further on in the pack, we've got a more positive. Actually, before I move on, I should say to this is an insolvency measure. It's actually an interesting thing when you look at this. The Gold Coast would actually be quite a high GDP area. So it'd be an area that, yeah, there's a lot of competition and a lot of trade. So it's not always a simple matter of, yeah, the most booming sort of economies have the lowest credit risk. It can actually be the inverse in many cases.
You know, we've had a question come in, which I think sort of touches on this. So I might ask it because it could be illustrative. So the question is, how are you building the index? I reckon there could be substantial differences within a region, depending on things like size, years since the company has been established, and so on. I guess you're taking these kind of factors into account, but it would be great if you could explain a little bit more about its construction. Yeah, that's interesting. Internal regions.
Yeah, so the most important point, sort of reinforcing what Pat said, the intra-region variability is much bigger than the across regions. So, you know, if you're an ASX listed company registered on the Gold Coast, your default rate was probably going to be about 2 basis points. But if you're the local cafe, it might be very high. So really important thing, the rating system underneath, it incorporates about 30 odd factors, including measures of the size and scale of businesses, a range of sort of behavioral factors, industry, and a whole host of other. So I think all of the points that were mentioned, all of those factors are in the rating system. But yeah, a really important point, with the way we see this being used is it's an average risk for the region. it's certainly, we would not want it to be used as sort of like a black spot sort of detector, if you like. So, you know, if I'm doing lending, I'll still lend to plenty of good businesses on the Gold Coast, but you need to look at this measure with, you know, all the characteristics of the individual business.
It's just one indicator, but its power is that it's forward-looking.
Yeah, and I think one of the key things that when we're looking in case studies and really digging into it, I think one of the most interesting things are where things are trending or moving. So, so like, for example, the CBDs, we're seeing sort of Melbourne starting to, the average credit ratings in Melbourne are starting to deteriorate quite a bit, and similar, actually seeing quite high trade payment defaults. So I think, you know, knowing the index of a region doesn't tell you anything about one business, but if you see the index trending, it tells you, okay, this area has, you know, got some drivers that are, you know, making it hard to do business or causing insolvencies.
So, James, were you going to take us through a perhaps better region, or an index, a region that's performing a bit?
So thinking about 4 slides time, Pat, we'll get on to Adelaide. So Adelaide, as a state, Adelaide's quite an interesting case. So if you look at CBDs, for example, Adelaide CBD is quite a bit lower risk than, for example, Brisbane, Melbourne, and Sydney. But the Adelaide Hills, sort of the suburbs of Adelaide, if you scroll to the next page, skip one more. Okay, so the index for Adelaide, it sort of routinely sort of sits in that sort of above sort of 8, sort of in the top 20%. And if you look on the next slide, the average insolvencies, they sort of, you know, consistently sort of track below the national average by quite a margin. Trade payment defaults on the next slide. We have seen trade payments defaults almost universally going up in lots of regions, even the lower risk ones, but still well below the long run average for Australia. And then probably the last slide I think is the most interesting one. If you look at sort of the more sort of structural drivers within a lot of Adelaide, to be frank, you get this combination that you actually don't see in many other parts of Australia, where sort of getting top ranked in things like the index of social advantage, incomes and things like that. So those things are related to essentially wealth, income, education, attainment level. They're actually in the top sort of, you know, close to the top 10%, but simultaneously they don't have expensive rental prices and very low personal insolvencies. So there's a lot of wealth in those areas, yet the commercial property rental costs aren't high. Most areas that have those sorts of statistics on the incomes and socio-economic status are at the absolute worst end of kind of rental costs. So that's sort of an example of a low risk. And I should say, you know, I've picked two examples across Australia. Within every state, you'll find kind of very low and very low, you know, high risk and everything in between.
It'll be fascinating as this rolls out, you know, to highlight different regions and to see the differences between them.
Yeah.
What about from an industry perspective? What does the index tell us about different industries?
Yeah, so one of the potentially the most surprising thing for me was, look at quite a lot of regional areas are quite low insolvency rates. So even if you take sort of Queensland, I mentioned had a higher than average risk, what you'll find is there's almost like a bifurcation of Queensland areas that are industry, you know, driven by the tourism industry, quite high risk. But if they're sort of in primary industry or you know, agribusiness, those areas actually can be quite low risk, and that's a theme sort of across the country. This chart here sort of shows a relative sort of average default rates or probability of default by industry. Now, no surprise, on the far left is essentially the hospitality, food and beverage industries. That's your cafes and restaurants and bars. That is a, you know, regardless of the extra pressures they're facing, that's a high risk business relative to other industries at the best of times. If you go down the other end of the scale, what we're definitely seeing sort of more primary industries, sort of agribusiness, mining, and then probably not too surprising at the moment, sort of health. The health industry is going quite well. So that's probably the key thing there. The next slide sort of shows a bit of information. Again, another factor in the rating system is business-to-business arrears. So this sort of shows a proportion of businesses by industry with 60 days or quite aged arrears. So the perennial sort of worst offender is construction. Really, that's a function of a lot of project finance. So you do get quite common to get 30 and 60 days arrears in the building industry. It doesn't actually equate to them being the highest risk. They're about sort of average. It's an average risk sort of industry, but just sort of slow payers. At the other end of the scale, again, you sort of see that sort of agribusiness and sort of healthcare. It's sort of the best performers. There's one more chart. It's sort of more of a broad sort of trend. This is the one that we talk about quite a bit, and
wow,
it's sort of this measure. I'll take a bit of time to explain it. From our data suppliers, we can measure the volume of trade receivables, which is effectively how much business our data suppliers are doing. And we're looking here at a year-on-year change in that. So where that number's zero, it means they're doing the same trade as they did the year before. Where it starts going negative, as you can see happened in that sort of the JobKeeper period I've highlighted there. That's essentially why JobKeeper was there. Businesses are doing much less trade, and had that quite significant sort of contraction. Things were actually getting quite good as JobKeeper was switched off. It was looking sort of that was a good timing for that. But then of course Delta hit us, and the lockdowns are back at worse than ever. So we've actually seen more recently the contraction even greater than the original lockdowns. And we're very much hoping that will bounce back after we all get out of lockdown, I might add.
Yeah, I'm sure we are. Thanks so much, James. It's an absolutely fascinating index, and I'm sure we'll all be really interested to see how it all pans out as the months progress. So I'd now like to hand back to Patrick for some closing comments. Patrick.
Yeah, thank you. And I might just stop sharing that so then we can see ourselves in a little bit bigger. So look, yeah, James, thank you for that. I think what's really interesting will be to see the change over the next 12 months. To be honest, 24 months. We don't believe that we're going to see the ATO and the banks in particular start to go hard on businesses from a collection standpoint. There's the ATO, as we know, is starting to issue notices of disclosure, which basically says to any business that owes over $100,000 and is not engaged with the ATO, that if they don't engage, they will have an ATO payment default registered on the Credit Reporting Bureau, which as a supplier, I think every supplier has long yearned for this sort of data. Far too often we see businesses fall over where they've been trading well with all of their trade creditors. However, it turns out they've got a significant or sizable ATO debt. That look, if everyone knew about that debt early on, they would have been able to either say no, stop supply, or at least reduce the credit limit, at least reduce their exposure based on the increase of that credit risk. So that's going to be really powerful. And the ATO, to be honest, has said it's already the issuing of those notice of disclosure has already started to pay dividends from a collection standpoint. So as taxpayers, we should be really happy about that, because at the end of the day, that's what we want. There's a huge amount of debt out there, and I have a feeling I read a stat this morning that SME tax debt had doubled over the last couple of years. So there's a tremendous amount of money that could be put to better use rather than just sitting as a debt. So that's really interesting. So our best guesstimates suggest that we won't start to see those collection activities really ramp up until probably middle of next year. We've got a few things to consider. That the states don't look like they're going to be fully open until probably early next year. We are due to get a federal election fairly soon as well. And at the end of the day, the government, the banks, and larger creditors don't want to be seen to be putting more pressure on in particular SMEs than they're already under. We can see from that receivable slide that we just looked at, huge reduction in revenue, which we expect to bounce back, but it will certainly take time to get back to where they are. In more positive news, and no doubt it's extremely tough out there. New South Wales is about to open back up, which is probably the single most important state. Putting bias aside, it was a big driver of the economy and of returning Australians through COVID. So that's a real positive. And then Victoria won't be far behind either. And then of course the states will open back up and international travel. So it's not a typical sort of long-term recession. It should be a fairly quick turnaround. It will just take time. Coming into Christmas as well is good. There's a lot to be spent with the sort of industries that have done it extremely tough, like hospitality, and also retail from a foot traffic perspective. If we just put the Afterpays and Zips and Kogans and whatnot of the world to the side, those customer facing retailers have done it extremely tough, being closed for so long. So I think there's a real positive there. There's a huge amount of resilience, and businesses in general have become really good at operating on a much leaner, obviously, revenue base, and have removed a lot of either red tape or processes out of the business, or automated them using technology. So I think there is some optimism there. It shouldn't be all negative. But look,
Patrick,
we're looking forward to next. Yes, of course, go on.
It was mentioned that there's some Creditor Watch exclusive data. Which data, and why is it exclusive?
Yeah, good question. So look, as I touched on it very briefly, 90% of companies that use Creditor Watch for credit reporting and monitoring and the suite of tools that we had that I skipped over in the presentation at the beginning, so we wanted to get into the juicy stuff. They use us exclusively. So any data that they're providing, sharing, leaving as sort of footprints, goes into producing, our credit rating, and ultimately goes up into the vacuum, and then James and Open Analytics team and a few others within Creditor Watch in particular, shout out to JJ, use to produce what we now see as the business risk index. So what does that mean? In sort of layman's terms, it can't be reproduced. Obviously, we've got these brilliant models and algorithms that have been produced, but also we've got this data as well. So it's a sort of two-pronged attack that makes it a really, really predictive, unique and quite exclusive index that will be launched.
And that's the final question, Patrick.
Beautiful. Well, look, Ali, thanks again. And James, as always, thank you very much. To everyone listening in, thanks for your time. Really appreciate it. Stay tuned for plenty more updates. We're going to have podcasts, videos, all sorts of things that we'll be releasing about the Business Risk Index on the 13th. Sign up to the webinar if you haven't already, to start to see some even more in-depth insights and live data, essentially. I for one can't wait. This has been well over 12 months in the making. So thank you all again. Great to chat to you about it and give you a little bit of a tease as to what's to come, and hopefully we will see you next week. Thanks everyone.